Welcome back to another episode of MonsterInvest. I am your host, Daniel. Today, I want to begin by asking you a question that might seem simple, but the answer determines whether you retire wealthy or you retire worried. Here is the question: if I gave you the best investment strategy in the world, a magical formula that was guaranteed to make money in the long run, could you actually stick to it? Most people would say yes, of course, but history tells us the answer is usually no. You see, in the world of investing, we are obsessed with numbers. We are obsessed with price-to-earnings ratios, interest rates, moving averages, and quarterly earnings reports. We spend thousands of dollars on courses, we read endless newsletters, and we watch charts until our eyes burn. We act as if the secret to wealth is hidden in the data. But the truth, the hard truth that Wall Street doesn't often tell you, is that the biggest risk to your portfolio is not the stock market. It is not the Federal Reserve. It is not a recession. The biggest risk to your portfolio is looking back at you in the mirror. Today, we are going deep. We are going to dismantle the amateur brain and rebuild it. We are going to explore the investor's mindset, how to think like a pro. To understand this, we have to understand a fundamental flaw in human biology. You and I, we are not built for the stock market. We are built for survival on the savannah. Think about our ancestors. If they heard a rustle in the bushes, they didn't stop to calculate the probability of it being a lion versus the probability of it being the wind. They ran. Fear kept them alive. But in the stock market, that same survival instinct gets you killed. When the market drops, your brain screams, run, danger, sell. But that is exactly the moment a professional is stepping in to buy. When the market is soaring and everyone is euphoric, your brain screams, join in, don't miss out, there is plenty of food. And that is exactly when the professional is selling. To think like a pro, you have to rewire your survival instincts. You have to learn to be comfortable being uncomfortable. Let me tell you a story to illustrate this. This is a tale of two investors. Let's call them Michael and David. Michael is what I call a first-level thinker. This is where most people operate. It is the year 2022. There is a fictional company called Nebula Tech. They make advanced batteries for electric vehicles. The stock has been going up for 6 months straight. It is all over the news. Everyone on Twitter is talking about it. Michael looks at the chart. He sees a green line going up. His logic is simple. The company makes great batteries. Everyone loves electric cars. The stock is going up. Therefore, I should buy. That is first-level thinking. It is simplistic. It focuses on the obvious. Michael buys the stock at $100 a share. He feels great. He feels smart. Now let's look at David. David is a professional. He practices what the legendary Howard Marks calls second-level thinking. David looks at Nebula Tech. He agrees that they make great batteries. He agrees that electric cars are the future. But David asks a different set of questions. He asks, is this optimism already priced into the stock? Everybody knows this is a good company, which means the price is likely too high. What happens if their supply of lithium gets delayed? What happens if a competitor releases a cheaper battery next month? David realizes that at $100 a share, the expectation for perfection is too high. If anything goes wrong, the stock will crash. So David waits. He does nothing. 3 months later, a report comes out. Nebula Tech has a slight delay in production. It's not a disaster, just a delay. But because the expectations were so high, the disappointment is massive. The stock plummets from $100 down to $60. Now let's look at the reaction. Michael the amateur is terrified. His brain is screaming lion, danger. He sees he has lost 40% of his money. He thinks, this company is broken. I need to sell before it goes to zero. He sells at $60, locking in a massive loss. He tells his friends that the stock market is rigged. David, the professional, sees the same news, but he sees it differently. He reads the report. He realizes the delay is only temporary. The factory is still there. The technology is still good. The company is the same, but the price is now 40% cheaper. David was waiting for this. This is not a crisis. It is a clearance sale. David buys the shares at $60, the very same shares that Michael just sold in a panic. Over the next 2 years, Nebula Tech solves its production issues. The stock climbs back to $120. Michael lost money. David doubled his money. They invested in the same company. They looked at the same data. The only difference was their mindset. Michael reacted to the price. David reacted to the value. This brings us to a core concept that you must master if you want to be a pro. You must understand the difference between price and value. Oscar Wilde once famously said, a cynic is a man who knows the price of everything and the value of nothing. The same is true for bad investors. Price is what you pay, value is what you get. Think of the stock market like a crazy business partner. Benjamin Graham, the mentor of Warren Buffett, called him Mr. Market. Imagine you own a business with a partner named Mr. Market. Every day, Mr. Market comes to your office and offers to buy your share of the business or sell you his share. But Mr. Market is emotionally unstable. Some days he is incredibly happy. He sees only sunshine and rainbows. On those days, he offers to buy your share for a wildly high price. Other days, Mr. Market is depressed. He sees only doom and gloom. He thinks the world is ending. On those days, he offers to sell you his share for pennies on the dollar. The amateur investor lets Mr. Market tell him what the business is worth. If Mr. Market is depressed and drops the price, the amateur thinks, "Oh no, something must be wrong, I should sell." The professional investor uses Mr. Market as a tool. When Mr. Market is manic and offers a high price, the pro sells. When Mr. Market is depressed and offers a low price, the pro buys. The pro knows that the mood of the market tells you nothing about the actual health of the business. So how do you actually cultivate this mindset? How do you stop being Michael and start being David? I have 3 specific mental models for you. Number 1, invert, always invert. This is a technique used by Charlie Munger. Instead of asking, "How do I make a lot of money on this stock?" ask yourself, "How could I lose money on this stock?" Before you buy anything, write down a pre-mortem. Imagine it is 1 year from now and you have lost 50% of your investment. Write down the story of how that happened. Did the competition crush them? Did the CEO resign? Did the debt become too high? By visualizing the failure, you force yourself to see the risks that your excitement is hiding. If you can't find a reason why you might lose money, you haven't looked hard enough. Number 2, extend your time horizon. In a sprint, luck plays a huge role. You could trip or you could get a lucky tailwind. But in a marathon, luck cancels out and skill takes over. The stock market in the short-term days, weeks, months is a voting machine. It's a popularity contest. It's random. But in the long term, 5 years, 10 years, it is a weighing machine. It measures real business performance. If you are checking your portfolio every day, you are playing the short game. You are subjecting yourself to emotional torture. A pro looks at quarterly results, not daily price ticks. If you want to win, stop trying to run a sprint. Start training for the marathon. Number 3, process over outcome. This is the hardest one. In poker, you can play a hand perfectly, based on the math, and still lose because of a bad card on the river. In investing, you can do all the research, make the right decision, and still lose money on a specific trade because of an unforeseen event, like a pandemic or a war. An amateur judges himself by the outcome. If he makes money, he thinks he's a genius, even if he just got lucky. If he loses money, he thinks he's an idiot, even if his analysis was right. A pro judges herself by the process. Did I follow my rules? Did I control my emotions? Did I do the research? If the process was good, the results will take care of themselves over time. Do not confuse luck with skill. I want to share one final short example, a historical one. Think back to the great financial crisis of 2008. The world felt like it was collapsing. Banks were failing. People were terrified. During the height of that panic, Warren Buffett wrote an op-ed piece in the New York Times. The title was simply, "Buy American, I Am." While everyone was hoarding cash, he was deploying billions. Was he scared? Probably. He is human. But he knew that the best time to buy is when there is blood in the streets. He had the mental fortitude to act when everyone else was frozen. That is the mindset of a pro. We have covered a lot of ground today. We have journeyed through the psychology of fear, the concept of Mr. Market, and the discipline of the long game. So before we close out this session, let's recap. Let's summarize what you have learned in this episode. Here are the key takeaways. First, you learned that your biology is working against you. Your natural instinct to run from danger causes you to sell at the bottom, and your instinct to join the herd causes you to buy at the top. You must fight this. Second, you learned about second-level thinking. Don't just look at the obvious news. Ask yourself, what is priced in? What does the market expect? The profit is in the difference between expectation and reality. Third, remember the story of Mr. Market. The market is there to serve you, not to instruct you. Volatility is not risk. Volatility is opportunity for those who are calm. And finally, focus on your process, not the outcome. A good decision that loses money is still a good decision. A bad decision that makes money is just luck, and luck runs out. Investing is not about beating the market. It is about mastering yourself. It is a lifelong journey of character development masked as finance. If you can conquer your own mind, the money becomes the easy part. Thank you for spending your time with me today on MonsterInvest. If this episode sparked a change in your thinking, subscribe and share it with a friend who needs to hear it. I'm Daniel. Stay disciplined, stay patient, and keep thinking like a pro. Goodbye for now.